So, what happens when the world's most critical energy artery, the Strait of Hormuz, is effectively cut off? Today, we're going to put on the hat of an energy market strategist to trace the shockwaves of that very event as they ripple through the entire global economy. Let's start with a question that, until very, very recently, was basically the stuff of nightmares for global markets. I mean, it's a fear that's haunted energy traders and governments for literally half a century.
Because that nightmare scenario, well, it's not hypothetical anymore. It is happening in real time. It's snarling supply chains, it's sending prices through the roof, and it's threatening a global recession. So let's break down exactly how we got to this point.
All right, we have to begin at the epicenter of it all, the Strait of Hormuz. What we're seeing here are some deeply contradictory signals, and that's creating an almost unbearable level of uncertainty for the markets. Okay, so this is where things get really confusing. On one hand, you hear these reports, from the Wall Street Journal talking about diplomatic off-ramps. But on the other hand, the military reality on the water tells a completely different story. And this is keeping markets on a knife's edge, just seesawing between hope and fear. And make no mistake, this is not some theoretical blockade. Iran is showing it has surgical control here. Vessel traffic has absolutely plummeted, the attacks are consistent, and they're even playing favorites, letting ships from countries like China and India pass through. And that recent attack on the Kuwaiti tanker, that thing was carrying 2 million barrels of oil, and it wasn't hit in some remote location. It was right in the anchorage area off Dubai. The message they're sending is crystal clear. No ship is safe. So all this chaos at the choke point is now creating the first massive ripple effect, an immediate and very severe shock to global energy prices. And of course, prices went wild right away. Brent crude shot straight into triple-digit territory, hitting its highest level since 2020. The market has priced in the immediate danger. But here's the kicker. Most analysts think we're just getting started. The forecasters suggesting that if this drags on for just another 6 to 8 weeks, we could easily see oil at $150, maybe even $200 a barrel. We haven't seen levels like that since the peak way back in 2008. And this really gets to the heart of the problem. We're looking at a massive structural supply deficit. I mean, even with countries releasing their strategic reserves and producers like Saudi Arabia cranking up production as much as they can, it's just not enough. The world is still short around 11 million barrels every single day. Now, this chart shows something really fascinating happening. We're essentially seeing a two-tiered oil market emerge. The gap between the U.S. price, WTI, and the international price, Brent, is the widest it's been in years. So what does that mean? It means that while the US is kind of insulated, the rest of the world is paying a massive geopolitical danger tax on every barrel. And to make things even worse, there are whispers that the US might ban crude exports, which would be absolutely catastrophic for allies in Europe and Asia who depend on that oil. But it's so important to remember, this isn't just an oil story. When it comes to liquefied natural gas, or LNG, the situation might actually be even more precarious. So here's the problem, right? While Saudi Arabia can at least reroute some of its oil through pipelines to the Red Sea, the huge LNG facilities in Qatar and the UAE, they can't do that. They have no alternative routes. They're completely dependent on the Strait of Hormuz. For them, there is no plan B, and that is putting immense pressure on gas-hungry economies all across Europe and Asia. Okay, so that massive energy shock is now triggering the next set of dominoes to fall. A severe strain on the global economy, pushing us dangerously close to a major downturn. And what's happening now is this incredible split in the global economy. The energy importing nations, especially across Asia and Africa, are getting absolutely hammered. They're dealing with crippling inflation, and many are being forced to cut fuel subsidies, which is a recipe for social unrest. All that optimism we saw in emerging markets at the start of the year, it's completely vanished. At the end of the day, this isn't just a headache for traders on Wall Street. It's a global growth problem. Sustained high energy prices act like a tax on the entire world, and the longer this crisis goes on, the higher the odds of a global recession become. Okay, let's zoom in on that third ripple, because this is where the macroeconomic pressure starts causing some acute stress in sectors you might not immediately think of, like technology and shipping. When this all kicked off, the conventional wisdom was, the tech sector will be fine, it's insulated. Well, as this report from Bloomberg makes perfectly clear, that assumption has been completely shattered. And this is exactly why. First off, manufacturing hardware, and especially semiconductors, it's incredibly energy intensive. These factories need a ton of power. Second, the global supply chain for electronics depends on air freight. And with jet fuel prices in Singapore topping $200 a barrel,
Profit margins are just getting crushed. So, of course, investors are running for the exits. Just look at Nvidia, a former market darling that has now officially entered a bear market. That tells you everything you need to know.
And just when you thought it couldn't get any more complicated, the conflict is spreading. We're now getting reports that Iran-backed Houthi militants are gearing up for a new campaign against shipping in the Red Sea. That would threaten yet another critical global choke point. All right, so that brings us to the final ripple, the one that lands right in your portfolio. With all this chaos and uncertainty, how do you even begin to navigate these markets?
So, with all of these interlocking risks piling on top of each other, what's the game plan for an investor just trying to protect their capital?
Well, if you listen to strategists like Anita Krishna, the CIO at What Bricks Capital Partners, the strategy is pretty clear. Get defensive. The playbook is about increasing your cash position to have liquidity, pulling back on your exposure to stocks, and holding on to a core position in some specific emerging market bonds. Basically, it's all about weathering the storm.
And all of this leaves us with one final and honestly pretty unsettling thought. The events we've seen may not just be a temporary disruption. We could be witnessing a permanent structural change in how energy flows around the globe and how geopolitical risk is priced into every single asset. So the question is no longer when things go back to normal, but rather, is this the new normal?